and welcome to the CNBC TV18 eBix Cash Studio. I'm Sumera Abdi and you're watching MF Corner. On the show today, we'll be discussing the very popular category of mutual funds, hybrid funds. And joining in will be Raghav Iyengar, the Chief Business Officer at Axis AMC. Hi, Raghav. Thanks very much for joining in. And, hybrid funds are something which have caught the fancy of investors. But not everybody is aware of exactly what are the various types of hybrid funds that exist, right? Just the one or two popular categories seem to be getting the bulk of attention. So let's start off first by explaining what different categories are there and, what are the peculiarities of each.
Thank you, Sumera. I think this is a very, very interesting topic. And I don't know if you've been watching the numbers, you're on top of it.
Yes.
This category has been seeing the maximum flows in the last 3 months, actually. So in some sense, shows like yours have actually moved investors into an interesting category. There are essentially 6 hybrid categories. The first one is obviously the conservative hybrid. The conservative hybrid fund is a very, very simple category. It has about 15% in fixed income and about 15 to 20% in debt and about 20% 10 to 25% in equities. The exact opposite of that is the aggressive hybrid fund, and as the name sort of explains it, the equity component there is actually about 60% odd. The debt category works out to be anywhere between 30 to 40%. The third category is the balanced advantage category, which is in some sense today the most popular category in the industry today. This one essentially allows the fund manager or the fund house to do essentially 0 to 100 in terms of its equity exposure. And the fund manager, the balance, there are 2 parts of the equity. There is one part which is the invested equity, and then there is obviously the arbitrage part of the equity, which allows the fund manager to sort of soften any, to maintain the equity exposure about 65%. The fourth one is the equity savings fund. This is another beautiful category. It's a mix of equity, arbitrage, and debt. Again, as you know, the arbitrage part of it and the debt part of it are used to cushion and to reduce the equity exposure. But because of the equity and arbitrage total, they will be at about 65%. So this gets equity taxation. Finally, of course, there's the plain vanilla arbitrage fund, which does nothing but buy between stocks of between cash and futures. And that, again, because of the equity exposure being about 65%, is treated as an equity fund. Now, except the first one, which is the conservative hybrid, which is treated as a debt fund, where you pay long-term capital gains tax if you hold it for more than 3 years. The others are all treated as equity funds in terms of taxation. So essentially anything that you own where your investment crosses 1 year, you are taxed at a concessional rate of about 10%. Anything less than 1 year, obviously you pay at about 15% right now. So broadly, I think, as you can see, these are, and I'm so sorry, the last category, of course, is the multi-asset category, which is a category which allows you to put money into 3 different asset classes. You have to have a minimum of 3 asset classes there, which is debt, equity, and is typically being called. Of late, you're seeing a couple of other options also getting into it. So these are the broad 6 categories of the fund of the hybrid space. The most popular fund category, of course, Sumera, as you talked about in the beginning, is the balanced advantage category. Yes.
Yeah. And, money has been coming in. Balanced advantage by itself is like standing out. But, I'll get to the specific categories in just a bit. Raghav, I wanted to just understand, where is this money coming from? Is there a sense that those who were earlier pure debt investors, are those the kind of investors who are moving to hybrid? And, isn't the flexibility of managing equity and debt separately in somebody's portfolio a big advantage for investors? Where is it that this hybrid funds are scoring?
No, so I think that's again a lovely question, because most people tend to assume that money is switching out of debt funds into hybrid funds. I think that's not the case. I think shows like yours have sort of educated investors, educated partners to make sure that the debt side is separate, should be used where you have expenditure which is really around the corner, and obviously safety is the primary prospect. And of course, hybrid is just in the interim between debt and equity. As you know, as I talked about, it's between these two. Where we are seeing a lot of money coming in is typically retail flows, and I think this is in some sense a reflection of the valuation of the market, because every time markets tend to get into a higher level, investors prefer to get into categories like this, especially first-time investors. So we are seeing a lot of first-time investors coming into these categories, especially the balanced advantage and the aggressive equity, aggressive hybrid category right now. Yes.
And, over here, I want to just point out to people who are watching not to be confused between the balanced hybrid fund and the balanced advantage fund. The balanced hybrid fund basically allows for equity to be between 40 to 60% and the rest of it in debt, like Raghav had said. And the balanced advantage fund is basically what is otherwise the dynamic hybrid fund, right? And between the balanced hybrid and the aggressive hybrid, SEBI says that an AMC must choose one. You cannot offer both. You must choose one. And like Raghav said, that Axis has chosen to have the aggressive hybrid fund. Raghav, am I right? And
absolutely. You got it spot on.
Okay, so now that we know the difference between this balanced hybrid and balanced advantage, let's talk about balanced advantage, because that really is a category that just continues to get flows all the time. Raghav, is there some kind of a market in which this category of funds does well? What is the allure here?
I think three things. I think one is obviously, it's very nice. Ideally, as you know, Sumaira, when a particular asset class gets a little expensive, ideally one should reduce allocation there and move to a different asset class. So one is obviously but that's easy to say, but in some sense, little difficult to practice. And unless you have a very good partner, or you have a good advisor, or you're very, very pretty much hands-on on it, it's very, very difficult to do. So typically these funds in some sense do that for you, because the entire equity exposure is determined by some sort of a preset formula. And there are 2-3 types of ways by which the equity formula or the equity exposure is sort of designed. One is obviously what we call the cyclical approach. Obviously, that's very easy to understand. As valuations keep going up, you sort of keep bringing the equity exposure down, right? The other one is, of course, what we call the momentum approach, which is depending on the way the market is directionally moving, you take a call on that. I think at Axis, we've sort of constructed something which is a mix of both of these. So we're trying to get the best of both worlds in our formula. So typically the way it works is that as markets keep trending higher, your equity allocations generally keep gradually decreasing. But because you have what is called the arbitrage element in that, your taxation part of it is yet considered to be an equity tax. So in that sense, you're paying a much lower tax, compared to the kind of equity exposure that you're taking. So in some sense, this is like if I would say this to a layman investor, it's a sort of a fill it, shut it, forget it fund. You're not really bothered about where the market is when you're investing. Should you be worried about the market level today, or markets are down today? For example, today is a bad day technically by market valuations. Markets have corrected last 3 days. Should I be putting money today? Should I be redeeming? All those questions essentially get answered by the construct of this particular category.
All right.
So I guess that's possibly the reason why it's attracting a lot of money, and it has done quite well. It has been able to protect downside. I think most investors, when they get into equity, their biggest worry is that, hey, what happens if the market really corrects and goes down? And unfortunately, that is the premise of equity. That's how equity portfolios are structured, right? They do go up and down. It's a volatile asset class. In some sense, this tries to sort of play or take advantage of that volatility and also try and give the investor a slightly more smoother experience.
Yeah, that's the thing, Raghav. I wish more equity investors were worried. It seems like they're only looking at the upside, not enough people are looking at the downside. Yeah. But let me also invite Ashish Naik, who's a fund manager with Axis AMC. In fact, he manages their aggressive hybrid fund as well as the multi-asset fund. So those are the two categories that we'd also like to discuss. Hi, Ashish. Thanks very much for joining in. Let's start with this aggressive hybrid fund. What kind of investors would it be suited for? What are the peculiarities, and basically what should one know before investing in it?
Absolutely. An aggressive hybrid fund, as you would know, invests about 65 to 80% of its corpus into pure equity. In Axis, we manage both the equity portion as well as the debt portion as separate portfolios. This fund is suitable for any investor who is looking for investing into the markets but does not want to go the whole hog by investing into a pure equity fund. There has to be some level of cushion, and to that extent, having some level of debt in the fund is able to produce that bit of diversification. So whenever there are market falls, it limits the downside of the overall fund compared to the, let's say, volatile market like pure equity funds. This fund generally is looked by investors who want to invest, let's say, from a 3 to 5 year horizon over a medium term and do not want to take a high level of risk. In general, if we look at how we manage this fund, we have generally about 70 to 75% of the equity portion into large caps and remaining into mid and small caps. So to that extent, we are able to give reasonable amount of returns over a longer period, maybe over a period of 3 years. These kind of funds have been able to limit the downside and hence be able to sort of give returns which are comparable to, let's say, Nifty or better than that, but with a relatively lower risk taken by the investor.
Okay. Ashish, the other category of funds which, has caught the fancy of investors is this multi-asset fund, right, where you go beyond equity, debt, and explore gold, etc. Again, who would it work for, and what kind of flexibility is there to move beyond just the three, which is equity, debt, gold? How about other asset classes like real estate? What else can be considered?
Absolutely. So as you know, a multi-asset fund by SEBI's definition has to have at least 3 asset classes, at least 10% invested in any of these asset classes minimum at any point of time. The fund that we have in this category is has about minimum 65% into equity, and generally we have about 70% invested into equity, and remaining is put into debt and gold. The idea of such a fund is that we know that various asset classes do not behave the same way in a particular year. So there will be years where equity will do better, phenomenally good returns, and there will be years when it will be probably negative. And generally what we see is there is a negative correlation between an asset like equity versus assets such as debt and gold. So whenever there is a market fall, we can see that gold probably, and there is a lot of uncertainty, gold starts to pick up. And at the same time, having a certain level of cushion from, let's say, an equity fall, from, let's say, investing into debt and gold protects that bit of downside. And what we see is in such a multi-asset fund, because of the benefit of diversification, the overall risk level of the fund goes down. To answer your second question, yes, obviously there are other asset classes such as domestic equity, international equity, commodities such as gold and other commodities, real estate. Each of these asset classes, whenever they are added to any portfolio of an investor, it kind of brings down the overall risk of the fund, and at the same time, over a longer period of time, it's able to sort of even out the returns, and hence the overall experience from a risk-return perspective is much better for the investor.
Got it. So, gentlemen, thank you very much, Raghav and Ashish, for joining in to explain this category of funds, the hybrid funds. And I hope that everybody who's been watching finally, there is some more clarity on exactly how these category of funds function. So thank you very much for joining in with